All right, this is the investment debate part 2. Last time we met and we had this discussion was about a year ago. A lot has changed. Everything has changed. I gave you guys I wrote you guys on our group. We have a group. And I reached out and I said, hey guys, the world is very different today. We had a discussion about, what people should be or should not be investing in. And today I feel even more confused, even more lost, even more puzzled than I was a year ago. Now, just disclaimer to anyone who watches this episode, none of us are giving investment advice, right? Although we like to think that we do, but none of us are giving investment advice. So please don't take anything that we say today as investment advice. This is just a discussion between 5 guys who have an opinion that they might like to share about what they've learned, right? And so the idea today is to kind of unearth that conversation and kind of extend it a little bit. And let me just set it up in the most naive, ignorant way that I know how to do really well.
Don't be. You're a great savvy investor, man.
He's got
you gotta
so
just
much better.
seriously. You want to?
He always does that.
Yeah,
I'm only here for the education. I'm just pretending like I don't know anything. I'm gonna.
You're savvier than all of us put together, huh?
He's made the most money on this property in Dubai. And I remember somebody's like, I bought a property, man. I'm not sure. He's probably like tripled the money that he put on it.
No, but did you see how he went straight to property? Strategic. Okay.
I was just going to jump in on the crypto thing and be like, he's made more money on the crypto side. After
all right. Anyways, this is not the point of the conversation. The point of the conversation is a couple things have changed. We've seen crypto act in ways that we did not expect it, in terms of mirroring, some asset classes that we didn't expect crypto to play like. We've seen ups and downs. Last time we were here was even before the rush of crypto. Right,
yeah.
It was still in kind of the.
It's technically done nothing since the last debate. It's gone up and it's gone down.
Exactly.
It's where it was.
So that's been a great investment if you were in it for 12 months.
No, but it ended the year up like 60%,
no, for sure,
right?
Yeah.
But since the point where we did the podcast, you mean? Till now.
Yeah, I think exactly. So we've trended sideways.
Yeah.
So if you're a trader, then you might have played that. If you're an investor.
And then if you look at just the basic market, took a hell of a beating recently, but generally, I would say not any less stable than, any other asset. And it's acting the way you would expect it to act given the crisis of kind of the economy and stuff like that. And then property, being in Dubai, property is mind blowing. We're seeing, numbers that we saw pre-crash, like 2007, 2008. And you beg the question, do you sell? Probably not, because you're going to have to go back and buy something, and then the market won't be very welcoming to that. But if you're treating it as an investment asset, it's actually the golden ages of property. So it's reaffirming its position. Then you have, gold back on
making a comeback,
making a crazy comeback.
It's only
Silver,
been 84 years, and
if you're a long-term investor, it's great. 80 years to get your investment back. But
no offense to gold.
But yeah, I just want to lay it out and say today I'm a bit I think I can speak for a lot of people. I'd love us to kind of discuss what's changed since the last time we spoke, and how do we feel about, how people should be, managing their spread, given the circumstances. I'll kind of open it up. Maybe we'll start with Steve and cryptos, just put a little pressure on him. And then we'll kind of go around and see what people think and how they want to introduce kind of their perspective.
Okay. I mean, no pressure. Yeah, like I said, so crypto is, in general, we've trended sideways pretty much since Feb 2021. So I think what's interesting on the crypto space, but if I speak of Bitcoin specifically, it's ultimately investors trying to figure out what it is. So on one side, you're looking at it and you're thinking, is this a hedge against inflation, kind of the gold play? And I think for a period of time, that's how people were like treating it. And then kind of over the last probably 6 to 8 months, you've really seen it come across as more of a risk on asset. So kind of the run up that we had as inflation started to really print high numbers, which I think we've all felt. it kind of peaked out, and that was almost when the shift happened. So I think the market started to realize, actually, from a monetary policy point of view, you're going to have to slow down on terms of QE. Therefore, it became, okay, this is a risk-off asset. The trend down and the kind of slow bleed that we've seen with the volatility is pretty much a byproduct of that. So I think the market's still trying to figure out a lot of stuff when it comes to cryptos specifically. Is it risk on? Is it risk off? Is it an inflation hedge? What does it mean from a regulatory standpoint? And I think, being in the market, as long as, if you've been in the market short term, this is all pretty scary. And I think you would be looking at your portfolio trying to figure out exactly what's kind of going on. But kind of the longer term investors in some of the more, let's say, stable kind of crypto plays, kind of understand that this is just par for the course.
So if you're not in crypto, do you get in crypto? Do you buy Bitcoin today if you're not in it already?
So I think, like, in terms of any investment today, if you're looking if you're trying to allocate capital, I think dollar cost averaging in, I said this in the last debate, there's a good time. Any asset class that has had a kind of 50%, 60% haircut, you could deem value if you value it, if you understand.
Yeah, but if you keep up to date on like what people are predicting, worst case scenarios, we're still assuming that a 2025 is still possible, $25,000.
Yeah. So precisely, but and this is why dollar cost averaging is so important. If you want to allocate capital to any market, any asset class, then taking some time to invest gradually, and then keeping some. I mean, in actual fact, the way that you could look at it is, if you wanted to dollar cost average in and gain exposure, then you could. We are at a point where we are teetering on the edge, arguably, of a larger recession. And during the kind of starting phase of a larger recession, you could see a liquidity crisis. And I think we can go on to the crisis later on in the discussion, but if that was to play out, then obviously, the kind of more volatile assets may take more of a beating. At which point you could increase, if you wanted to, your dollar cost averaging in and increase your exposure if there's a sharp drawdown. And I think my advice would be to understand what it is that you want to allocate and how much, and kind of make sure that you're allocating across different asset classes that you understand. And then understand what a recession could do and what a liquidity crisis opportunity might bring you.
And how does regulation kind of impact this?
Regulation is going to be a continuous debate until probably 2030. So, latest news on the regulatory front, I think we just saw this week, actually, the executive order coming out of the US, where the US is actually now taking a stance, and respectfully, they are looking at it and saying all government agencies need to collectively come together over the next 180 days and really assess the opportunity and value proposition and risks associated to this asset class. So I think at a US level, from a democratic kind of Western world, there is a more friendly approach that seems to have been discussed. And then just the other day here, that same day actually, we heard that regulation is now being formed and drawn up over the next few weeks, months, kind of straight off the back of that. So I think if you wanted to gain exposure and you wanted to understand kind of what's going on, if you were to keep your ear to the ground, at a regulatory level, I think the world is warming up. I think there is a divide. It's West and it's East. There's centralized and there's decentralized, which is almost a kind of like the freedom and the controlled kind of view of the world. And I think if you're trying to play things like at a I guess at kind of a macro level, I mean, the whole geopolitical issue at the moment, you can't base your investment decisions off that, because that's changing like the wind. So, taking your time, investing gradually is probably the best advice I would give it if you wanted to get into crypto today or any of the other asset classes. These guys will probably say a similar thing, or maybe not, but you should probably ask.
Yeah. On that note, Mark, what's changed for you guys from a year ago to now? What's your outlook? Has it changed? Do you have any kind of learnings, insights?
Yeah, I think Steve, you kicked it off really nicely, and I would agree a lot with what you said. Personally, I always advise to zoom out. Luckily, in the last episode, we didn't really say this is where we're going to be 1 year from now. Yeah. So when you zoom out, you don't necessarily see that much has changed. Each asset class has a purpose on what it's supposed to achieve. So rather than a debate, it became more about having exposure to a lot of asset classes, whether it's crypto, real estate, stocks. So each one has its place in your portfolio and its allocation. And if your goals haven't changed since last year, well, there isn't really any action for you to take at this point. So that's why we always start with goals at Sarwa, where we say, what are you trying to achieve? Are we looking at a 5-year window, 10-year window, 30-year window? The more time we have in the market, the better, the more we can take some risk. So, and based on that, that's where we can allocate more into riskier assets like stocks or safer assets like real estate. And crypto is a bit of a unique beast. It's a new asset class, despite it being a decade is still new compared to the history we have with others. So for us, I would say nothing is too atypical. In fact, we're talking about a downturn or a correction, but it's nothing compared to what we lived in 2020. It still hasn't reached that level, and I feel like a lot of us are a lot of people think that retail investors are panicking right now, but when you're in the business, we're seeing the most amount of volume we've had. A lot of people are buying the dip, taking advantage of lower prices because they're accumulating wealth for the long term. So that's really the good news, and within all of a lot of very devastating news is that at least the behavior of people is very resilient. That's what we're seeing.
Yeah, I think it's super interesting to hear that. I wasn't expecting you to say that, to be honest. I naively believe that in this type of a market, most people are slowing down, but to see that the volume is a bit unchanged and actually people are participating in the dips, that's super encouraging.
There's a lot of money around, right? So, I mean, it's a lot of it got invested, but we're at peak liquidity, right? In terms of overall how much people have wealth to invest, right? So, if they have on the sidelines, they could pick up, a good dip, like you're saying. The worry, and this is not us trying to time, is like looking at the macro trend, looking how things are going to play out over the next 5 to 10 years. I know if you have a view of 5 to 10, 20, you disregard that. I think it's more engaging if we kind of also think about what's going on, right? Because we're in the middle. I think last time around we were in a situation where a very bullish situation. I think all the asset classes benefited from the reflation, the central banks printing money, lower interest rates, the debt monetization, and they had to do it in the wake of COVID, right? But I think we're in a completely different scenario today. There's going to be a shift in the kind of economic conditions already. We're feeling it, right? With inflation printing at 8% just this month, and it's been at 7%, and it seems to be like a trend that's not transitory. Think
transitory. What a word that was.
Yeah.
What a word.
They had to dismiss it, right? They
Of
have
course.
to continuously, make people feel good. But
Word of the year.
But guess what? This thing might be here to stay, right? So in that type of scenario, in that kind of environment, I would like to actually ask you, in terms of portfolio allocation, what are you advising in terms of rebalancing or reconfiguring? Because typically in that environment, stocks are punished, right? And I don't know if you play that game, the 5-year game, because I hear a lot of news as well. I read a lot of news, something about lost decade in equities. The profit margins are gonna shrink just because inflation is around. Is going to be this high. They can't pass on all that that cost increase to the those expenses to the customers. So companies will kind of suffer. I think. The way I see it, there is real assets, at least to shift it a little bit to where we live. Real assets.
Physical and digital assets.
Yeah.
Physical assets is what
Real
you're
world
referring to.
assets.
Yeah,
Let's put it this way.
Brick and mortar.
Real world. Yeah, real world. These days, we got to say real world versus digital, virtual.
Yeah.
Not fake.
Tangible, whatever you want to call them, hard assets are still a good storehold of value. I'll question whether the digital gold concept applies to you at Bitcoin, and that'll be an interesting conversation too. But for us, in terms of having a tangible asset class that, again, I've circulated an article about this. Most amount of wealth has been allocated to real estate during this overall this 40-year period where bonds have kind of been the best performer in terms of rates coming down and how much money is being printed and balance sheets increased. And a lot of that has been allocated. Most of that, I mean, a huge chunk of that, I should say, has been allocated in terms of percentage. Global balance sheets have allocated to real estate at its highest level right now.
I mean, that's
for
a
a good
lot of
reason.
BlackRock, right? As the pension funds have been buying up a lot of hard assets and reallocating them.
Yeah,
So that's
yeah.
kind of where a lot of that.
Yeah. And there's been even like the governments have allocated to gold to hedge against the shift in the US dollar that's inevitable, perhaps. You know, so
There's
a
like
lot of the
5
huge.
things we need to talk about.
Yeah, there's so many things. I'm just putting down I'm saying the seeds, and I'd love to talk about each one.
I just want to say something. Although we could speak about this topic, each 5 parts of it, over like 4 hours, what I'd like us to really think about is how we can really compress this into something that can be super valuable for someone to watch within like 20 to 30 minutes time.
Sure. I'm getting there.
Just a few points.
That's an edit thing, by the way. River, you can just do the, like YouTube videos.
Yeah.
20 minutes,
Sum
20
it up.
minutes, 20 minutes, 20 minutes.
Yeah, I
Sorry,
think
yeah.
I was gonna
let's-
get there. Yeah.
Let's remove what we're not talking about, which is in an environment like you described with high inflation, we're not discussing cash and saving accounts, right? So let's at least
performing assets.
So let's at least remove something that still makes up a huge part of people's wealth, because if you're not investing it in any of the asset classes we're talking about, it's losing money every year, and that's usually a shock for people, because you look at your bank account and you see, let's say, 50,000 dirhams, but that's not really true, right? Every year it's losing value because things are becoming more expensive. So the first step is really to acknowledge that doing nothing is problematic. And we all need to act.
And
based on that.
especially, I think, sorry to cut you off, especially versus what we were talking about a year ago,
Yeah.
that statement is 10 times truer.
Yes. Yeah.
And I think that's something that we need to highlight specifically. Like, if you haven't placed your money or made your money work a year ago, and you still haven't done it now, you've actually lost tons of value.
Exactly.
Yeah.
Exactly.
Then it comes back to, okay, well, things are different now. There's a lot of people putting money into gold. Should we shift? Should we do these, what we call like tactical allocations and tactical shifts? Absolutely not. This is where a lot of wealth managers end up underperforming the market, is because they don't resist this urge to, they move with the wind, they act on their emotions. And that's why we were saying a lot of great data on gold. It's a very bad performing asset. It does only well when things are, when there's panic mode in general. Exactly. So that's why, like, you don't really, you need to tie your investments based on your life expectancy, which is hopefully we say عقبال in Arabic and 100. So this is why it's important to, it's part of being an investor to experience short-term losses. You can't have the long-term gains if you don't experience short-term losses. So really, I know it's more interesting to try to move your portfolio around and feel like you are doing something to weather the storm, but a diversified portfolio is already built with this in mind. So anyone trying to convince you that a lot of change is required based on that is, I think, it's false, because there's we always say we never lived in a certain time in the market. Think of World War I, World War II. Think of the environment back then and the amount of uncertainty. And every single crisis we've lived, we've rebounded from it. And that's why things trend up and to the right. So back to crypto, that's where a lot of people are saying, oh, well, Bitcoin didn't really act on a lot of what it's supposed to do. Well, that's not true. In a crisis, all the correlations where, correlation meaning the link between all asset classes and how they behave simultaneously, it's known that in a crisis, everything correlates to one. So it's not really a fair assessment to say, well, Bitcoin didn't really do what it's supposed to do when we're living in something very unprecedented. We have to really zoom out again and see how is it going to behave across a multi-year period.
It's the first crisis you got Bitcoin goes through, right?
So, I mean, Bitcoin itself, it's been through many crises, right? As such a young emerging asset.
But I mean, sorry,
It's a global crisis.
in terms of a global
economic debt
situation.
crisis or
Yeah,
even
yeah.
a wartime.
So I think what's interesting with, Bitcoin stocks, tech stocks, if you wanted to kind of look at it as a whole, like however you want to see it perform, and I think what's interesting with Bitcoin specifically today is how is it going to react during a period of time where there's, say, where there's a slowdown in economic growth, where there is more kind of recessionary pressures put down onto the market. I think that's going to be interesting to see whether that kind of continues its correlation or its flow in terms of growth. Fundamentally, Bitcoin, to continue appreciating in value and seeing that growth, is all about its network effect. Is the world adopting it and using it? Are people building products and technology around it? Not just Bitcoin, the entire ecosystem. And I think if you kind of are interested in that asset class, you really want to try to understand Metcalfe's law, network effects, to see kind of what's happening, because that's really your kind of signal in the market as to what's performing and what's not. And I think, today the network is stronger than ever. It's weathered numerous challenges across different markets, be it China chucking it out, be it an energy crisis in Kazakhstan, be it Russia and the Ukraine crisis today, regulations in the US. So it will continue to weather different storms. And I think the way that I view it is, my general kind of thesis is that more and more people year on year are adopting the use of cryptocurrency as a whole. And as long as that network adoption continues, then it interests me as an asset class. And kind of, I think as regulation becomes more clear, I think investors are going to really start to hone in to understand kind of like what's a safe kind of bet when it comes to the crypto space and what it kind of further out on the risk curve. Mm-hmm. And that's why you have to stay on top of that industry specifically. And I think the environment that we're entering now, and I think you hit the nail on the head in terms of, there's no certain times in markets. I think this decade is going to be super uncertain. There's going to be a lot of kind of chaos there, and you have to look at it from a life expectancy point of view. I genuinely have stopped caring about the day to day. Yeah, I just have no interest in that space.
So just to make this a bit more relevant, a bit more personal, without sharing our own spreads or anything like that, we're basically in our 30s and 40s, right? Mm-hmm. So early 40s, mid 30s, etc. We basically have a horizon till our retirement, let's say at least 10 years. So it's still a 10-year play at least, most likely 15. If you have a 15-year horizon and you want your quality of life, so you want some short-term wins too, and you would have a magic wand to decide what your spread would be, what do we think would be a right mix today? And there's a risk appetite issue, there's a personality issue, there's so many factors, but generally speaking, I would love to see what you guys would say to that.
Yeah,
go ahead.
Chris, I just wanna challenge one concept on tying your allocation based on your retirement, which is a common issue. Let's tie it based on how much you want to live, because it's not true that when you retire you're gonna withdraw all of your portfolio. That's a common. So you need it past that, right? So it's more start with how much am I planning to live.
and add inflation on top of that as well.
Exactly, but I know not to be annoying, but it's just
I think you're absolutely right. But I think understanding like your lifestyle needs,
yes,
on a regular basis, and understanding that there's a kind of a horizon to your kind of game plan, right? Yeah. I think that's what I'm trying to frame. But absolutely, I'm not gonna cash out all my money and sit on it, at 55 or 60, right? So 100% agree with that. Thanks for clarifying. But what would be kind of our recommendation as a spread today?
You guys want to kick off? I'll go last.
I mean, for me, I'm the most bullish on real estate. I think you should allocate. We've seen it now, with interest rates when they were very low, people were buying homes. You saw it in Dubai, where you mentioned when we first started, what happened in Dubai over the last year. And I think, a lot of people realize this is a fantastic place to come, whether it's to retire or to live here. And they handled COVID fantastically. And people are saying, is this because of COVID or is this because of Expo? I think it's both. People have realized this is a fantastic place. And when interest rates were low, you saw a lot of people who were renters buying homes.
Yeah.
And that was fantastic. But as interest rates start going up, I still see real estate as a great investment, because if someone doesn't need a mortgage, can still buy it, then people who wanted to buy are going to rent now. So the rental market starts going up, which is very interesting from an investment perspective. I do think real estate is great for generational wealth. So if you're talking about, the long term and you want to buy into something that does create recurring income, as you just said, real estate has always been great because it does create that income for you. And if you look at what happened over the last 20 years in the market's always, it goes down, but eventually goes up, especially if you're buying the right asset.
Yeah.
And today what we see from all our investors coming into Dubai is people want a piece of real estate in Dubai. And it's not just Dubai. Globally, real estate has done fantastically well. And I think COVID's really honed in on that. And they said, people need a house, you need a place to live. Whether you're a renter, an end user, people need a place to live regardless. And I think people are spending a lot more time at home than they used to. So as an asset class, I would allocate a significant amount of my wealth. If you don't own a home, I think you should buy a home before interest rates go up.
Or a share of a home.
Or a share of a home, of course. I mean,
exactly.
Yeah, because you should expose yourself to real estate, whether it's through a stake, whether it's through, getting a mortgage and buying a home. I think having exposure to real estate is very important.
So I think what you said is really interesting. I just want to highlight one specific piece that I think is we say it like casually, but it's a fundamental shift, and I think I just want to highlight it. People's perception of personal value to property has tremendously changed in the last 2 years, which I wonder what the impact is on the asset. So if the inherent value to a person has increased, naturally the asset will follow.
Yeah. Absolutely.
Yeah.
Right? So
Absolutely.
as an asset class
Residential.
versus our last conversation,
Yes.
I would
We
be
were in the
comfortable
midst of
to
it.
say that our perceived value of property has gone higher,
course.
and naturally that's followed with how the market is pricing it, right?
Yeah.
Yeah.
And so I think that's something that's fundamentally a shift forever. It's not a COVID thing.
No.
It's the perceived value of property today is higher than it was 2 years ago, higher than it was a year ago, and naturally the market is factoring that and repricing it.
You see that
And
in
we're seeing
luxury
it globally,
market, right?
Like we were just talking about. Oh, Dubai, it's amazing.
Yeah.
On a personal level,
We can. Yeah.
property in Canada for me is outperforming property in Dubai.
Yeah.
Can we just caveat
Depends
that?
where. Depends
Yeah.
where.
Can we just caveat that because
Yeah.
it's outperforming because the denominator is like getting destroyed.
Which we are pegged to here.
Yes. Yeah, exactly.
So,
So-
it should apply
So,
equally.
let's
it applies.
understand what
So-
assets.
so it applies here.
Yeah, but the Canadian dollar,
It's following the same inflation as the US.
Chris,
No,
you got
not-
properties that are up 50-60%
Yeah.
since last year.
100%,
right?
yeah.
In the luxury space.
100%.
That's why.
But that's what I'm saying. But I just wanna say that it's not. I think to your point, and this is what I really want to highlight, is that it's not necessarily just the market. It's not a demand and supply. It's the perceived perception of the value of the asset
That's
as
how
well.
markets operate. Yeah, a lot of
but,
it's
but I think that
psychological.
psychology of
Yeah.
property versus
It has
2 years
a
ago, a year
paradigm
ago,
shift, yeah.
has added.
But that's why the luxury market flew here, because
Yeah.
people realized, listen, I need a home in a place where, regardless if there's another pandemic, everyone's saying we're bound to have another pandemic in the future. I want a place where I know that the government handles it well. Even if I'm paying $10 million, the luxury market here, average $10 million homes had the record this year of how many luxury homes have sold. And they're like, okay, listen, this is why the perceived value, going back to what you're saying, is, regardless of what I'm paying, I want a place where I know the government's going to handle it very well. It's going to be safe, and I want a roof over my head, regardless of what I'm paying for.
And this is what I'm saying. I think,
I'm gonna
and
be
just
so
to Chris,
controversial in a minute.
and
Just to be clear.
just to crystallize that point, I think people are not looking for houses; they're looking for homes,
Yes.
right? And I think that is like the critical difference in how the
Yep.
asset is being valued today versus 2 years ago.
Yep.
That's what I just
Oh,
wanted
there's
to
still
say.
opportunities within commercial real estate. Don't get me wrong. People in
sure.
in developed markets are still investing in that asset class. But the multifamily, the residential, is more relevant, more powerful than ever because of that perception shift. Maybe COVID. There's a bunch of different things.
Yeah, remote work,
Yeah.
the new lifestyle.
Yeah, I was gonna add to that. Like, it's not with the Great Resignation. People that want to move. I can tell you from myself. Like, I had a property in Canada. It hasn't gone up. You're lucky that your property went up.
Here's in Toronto. Here's in
No, mine's in
Montreal.
Montreal. Mine's in
Exactly. So
Montreal,
I
yeah.
think a property is very much like buying a business. It's much more. You need to select that specific unit.
I must be a great investor, guys. I must be a great
Might be.
investor.
That's what I told you in the
You
beginning.
might be a good investor. So that's why it's much more tied to that specific property. So when we talk about a global level or you're diversifying it, yes, I think no one can doubt that it's been a great asset class and that you should have it in your portfolio. But to tie a large chunk of your wealth in a property is really a shame, especially with remote work when we have much more flexibility. A lot of people are actually shifting towards rent and maintaining that flexibility to make sure that they can move if their plans change, if they get a new job, if they decide to live by the beach instead of the mountains, whatever it is. So I know I agree with the value of real estate is going up, but the perceived notion for a lot of people actually wasn't so. It was, I don't know if I want a mortgage for 30 years. I don't know if I want to commit.
It's a great plug for these guys.
But they're
'Cause
waking up.
they're
They're waking up to as well. I mean, millennials and Gen Zs don't own houses. They don't own real estate, and that's why they can afford to participate in the wealth creation that's happening
Without the hassle of being
without the
tied
hassle
to
of being
a
tied
place.
to it and a mortgage.
100%.
I've paid the price of doing that at a young age.
Yeah.
I don't recommend it. Like when I first moved to Dubai, I bought a house in downtown, took a big mortgage, and it was 2007. I saw 40% up temporarily before it crashed, and I was 50% down. I've been hovering around 25% down with interests racking up.
Yeah.
Like, so I'm like 50% down
Yeah.
underwater after 15, 16 years.
Yeah.
So
Yeah.
that painful mistake is partly why I started Stake, because I don't want people to like, repeat the same kind of thing. I want to do it justice, and it's painful at an early age. So it's very right to say that the millennials and Gen Zs don't own real estate, and that's why we want to open it up to them, give them access to it, give them liquidity. This is what we're doing at Stake.
Yeah.
You're saying something, so they prefer renting. You're just saying, so that makes that for someone who doesn't need a mortgage to buy a home, the yields then become very good, right? Because as more demand for rent comes in, the yields start increasing, and that's where home ownership for someone who's an investor becomes very interesting.
Just on the rent, just on the renting thing, I think there's like some that prefer renting because they like the flexibility that comes with that. But there is a concerted effort to like take more people to a renter's market, and that inflation of asset prices is kind of, especially the real estate piece, is what we're starting to see, which is going back to the point when I said, the likes of BlackRock and Vanguard, these guys buying up real estate. They're not just buying up a house, they're buying up streets.
Yes.
Yep.
Right. And they're overbidding for that street, which prices out the everyday person. There is an objective there. There's a reason for that. I don't know the specifics without being super subjective and opinionated, but fundamentally that drive up is forcing a market to say, hey, I prefer renting. Actually, you just don't have a choice.
True.
Right? So there's dynamics at play here that are far above where my understanding of it is, but there is a beauty of flexibility, and then there is kind of, I have no choice.
And that's a critical distinction.
Mm-hmm.
Because although renting is a great option, and if it suits the short-termism that lots of people are feeling, then okay. But fundamentally, owning an asset, one that you can afford, right? One within kind of, potential of growth over a longer period of time, and having a stable asset long-term and owning it outright is a very good thing.
Mm-hmm.
No, of course.
As long as it's
Path to
within
ownership,
your means, right? I mean,
You're not overstretching yourself.
And I think
though.
that's the critical piece. Right?
I just want to speak on the property piece as well. It's kind of property, and I guess this plugs Bitcoin to an extent. So one of the reasons that I really like Bitcoin, and I think over the longer term it will perform well, and the crypto asset class will perform well over a longer period of time, is because when you look at some of the value propositions of it, the whole idea of owning property, and what we have seen today, like I own physical Bitcoin, digital Bitcoin, but it's offline, it's mine, it's cold. It is seizure resistant to an extent. You could take my wallet and then beat the passphrase out of me. But the seizure and the freezing of assets that we have seen in Canada, which was shocking to see the way that played out when, the letter of the law was never really exhausted. It was just jumped straight to emergency measures. We've seen it with the sanctions, obviously, the crisis with Russia and Ukraine, the seizure of property, the seizure of assets, physical assets, and the discussion of seizure or freezing of sovereign funds. Arguably, if you're an investor, should be something that you should understand what the longer term dynamics of that shift of money and wealth will be. Because as far as my opinion on it is, I believe that on last Wednesday, when those sanctions were put in place and the freezer of those sovereign funds were enacted, the way that the world should be looking at what money is and what wealth is and what property is and what assets are completely changed overnight. We probably, and I think, what's his name? Polzar, he's one of the analysts for Credit Suisse, I think it is. But he released a report, and one of the things that he said is that his view was that Bretton Woods 2 officially really ended that day. And if you don't understand what Bretton Woods is, I'd advise you to go and understand what Bretton Woods was and what maybe it becomes. And I think today I'm more uncertain as to where I would allocate to. I firmly believe that there's a place for Bitcoin and crypto industry. I think within the stock market and stocks, I don't think you're a stock picker. I think you would diversify out. I think there's great opportunity within innovation and this is why I reached out to you recently, in terms of the innovation and kind of like tech space. If you take a 10, 15 year time horizon, where is humanity going to progress to and what changes are going to happen? Because that's where you can allocate to. And then there's value aspect stock as well. So I think stock's a great place. And I think real estate, I think what you guys are doing in terms of being able to own shares of something and diversify out as opposed to locking it in one place is an amazing opportunity with great growth potential.
It opens up a lot of possibilities.
And it means I don't have to tie
fractionalize
my
and
wealth down
digitize
as well.
Yeah.
So,
But
yeah, that's my view on it today. Is that like the broader spectrum, but understand the dynamics at play. This isn't a case of you need to understand what money is and what money is likely to become, because it's changing and it's changing faster than any of us imagined.
Money is changing. That's why you need to be invested. And to bring it back, I completely agree. The long-term trajectory, the long-term trend for Bitcoin, I think is exponential. But again, untested, it's a brand new asset class. It's only 15 years old. It has a lot of room to grow, and it's scarce. So that's the main bottom line. Decentralized and scarce. Yeah. That's why I call into question things like regulation. How much regulation is actually going to be fitting for this asset class, because it kind of almost defeats the purpose. We can keep
it's Bitcoin.
Yeah,
like there will be some form of regulatory clarity there, and then the asset class.
But the anonymity of the asset class is one of its main use cases as well, right? So you're seeing adoption really increase a lot now with Russia and the sanctions there, and people wanting to move their wealth because the SWIFT system is getting shut, right? So it's super interesting to see that, but it opens up all the different possibilities that maybe central bank what do you call them? Government stakeholders didn't kind of think about, and they could. There's that risk of always, if something becomes too big and it starts to threaten, the reserve currency system's ability to control money and print. There's always the flip side to it. And I'm bullish. Don't get me wrong. Yeah. There's always a flip side to it that we've seen governments ban it and clamp down on it and stuff like that. So that's the risk you run there. But it is a very passionate. It's a narrative. Yeah. Really, you're buying into the narrative. Just to bring it back to what we would do at our age. Yeah. We're millennials. We're different than other kind of age groups where they can they typically, like me in the past, take idiosyncratic risk or what do you call it, single asset bets, and like to have a story around it, and then they learn, and then they realize that it's better to be spread your wealth and those sort of things. The balanced portfolio view is for sure. Previously, there used to be the 60-40 split of stocks and bonds. That was the traditional mindset, and what I think. What's been proven actually is in that portfolio, and Rami is a bit too bullish on concentrating more in real estate because you get that passive income. It's and today's bonds don't give you anything. Real estate gives you 1.5 times dividend income and more than 2 times what you get out of bonds and investment grade fixed income. So if you want a passive income at a later stage in your life, or you want a second source of income, it's really a good place, and it's inflation hedged because you can pass on the cost of higher expenses to your renters, right? Contracts are 12 months maturity, so you can afford. There's always a rent increase to match inflation. That's why it's an effective hedge against inflation, real estate.
But that's an assumption that wage growth will continue, or government will step in with some form of UBI, particularly in the markets.
It starts to get called into question in a stagflation environment, and an inflationary environment where wages aren't necessarily falling. We can debate Dubai as well, how jobs are accelerating here, and how this is the kind of place where you can hedge for inflation, because there's a lot of windfalls. To bring it back to Dubai, there's a lot of windfalls in a place like here. Yeah. It's really a net beneficiary of a lot of things that are happening in the world. But in terms of portfolio allocation, when you put 20% of your portfolio, right, in real estate, you keep 50 in stocks, 30 in bonds, that kind of split has scientifically shown to reduce your risk significantly, right? Go kind of in the chart, go left and up, in the sense that
Won a Nobel Prize. That's
Yeah.
portfolio theory. Yeah.
that's the portfolio theory. So yeah, you reduce your risk without reducing your expected return. And so it should form part of every portfolio, whether it's 20, 30, 40%, but it should be there for a good reason. That's what takeaway for me.
Yeah, I like that you're making it more real and introducing numbers, and I think that will help the listeners. Whether it's 60-40, there's a lot of numbers being thrown around. One of the aspects is our age. That's a big one. There are many other aspects like our appetite for risk, our investment experience. I'll tell you in my case, or the majority of Sarwa customers that are in that age bracket and are typically more on the aggressive risk-taking side, they will have the majority in stocks, a bit of bond exposure. You don't really appreciate bonds until things hit the fan and everything's going down and your bonds is like more or less the same.
Bonds are technically like a play now. No? The potential.
No, it's a really bad market.
It's a bad market for bonds. No, it's been a bad market for bonds. Now,
Again, we're not looking at now, right? We're looking at a 10 plus year view.
I'm never going to buy bonds. never.
Really, I would have never
forward?
assumed
Yeah,
that.
okay.
You're saying moving forward.
The crypto guy will never buy bonds. I never would have imagined.
Steve is unlikely to buy bonds.
Never.
Moving
Sorry.
forward today.
I'll challenge you on that. I'll challenge you on that
that's
for
fine.
sure.
Sorry, it's not Steve. It's Huddlebeck.
At Hodderbeck.
At Huddlebeck. Sorry, continue.
No worries. It was just to basically say like the exact split between stocks, bonds, real estate, crypto will vary. I think the way I like to see it is my money is in all of these assets, so I never feel FOMO when something's going up. On the contrary, and if something's going down, well, I know my money is elsewhere as well. I like to. There's a framework I'm really enjoying, which is the get rich quick and a get rich slow mindset, and it's important when you're to acknowledge what you're doing in each one. The majority of once you make money, once you have taken certain bets, such as in a startup or on crypto, this is where you want to rebalance and put it into safer assets like real estate, like stocks, like bonds, to preserve your wealth. So I think to be a great investor is to shift between being aggressive and defensive. And in general, we can say 80% of your wealth to be defensive and use that 20% to be more aggressive. There's a lot of numbers being thrown around. I don't think the precision matters as much as do both, because if you're just being defensive, well, you could have missed out on the potential of a lot of things.
Just outline what a defensive asset would be in your bulk.
A defensive asset is basically a very diversified portfolio of ETFs, stocks, and real estate, assuming the real estate is diversified. That's defensive. An aggressive one, I would say, this is where I would put crypto in that bucket. I would put stock picking as well. If you're betting on a specific company, I would put betting on a specific asset, a real estate asset. Again, we've saw different. So many of us have real estate, but we've lived very different returns. Some of it is negative, some of it is positive. That's still aggressive because you're putting your wealth in one specific unit. So each asset class has the potential to be both defensive and aggressive. If I'm diversifying my portfolio across thousands of stocks globally, that's defensive. If I'm betting on Coinbase or on Robinhood or whatever it is, that's aggressive. Same thing with real estate.
You can bucket it in like growth stock, like rely on growth, and then the value stock piece. That's another way of looking at it on a broader scale. Yeah, I completely agree.
Okay, that's super interesting. Okay, guys, we've been talking for about an hour.
Already? Wow.
Doesn't take much for us to talk.
No.
We've been talking about money, and we've talked about money before. I had a podcast with a guest about 2 weeks ago, and there was a conclusion to our conversation, which I think appropriate for this as well. Although we all obsess about money and building our wealth and I guess unlocking our freedom in essence, I think it's just a big reminder that you know, in life, the best things are free. You know, and one of the conclusions, you know, we're all startuppers. We've all built or building brands, and we're all building our futures. And one thing kind of stuck out in our conversation that, you know, a lot of the founders that I know, that we know, and I've had this conversation with a few of you guys too, and I'm not going to put you on the spot, but a lot of people today that are building organizations, building their futures, building startups for their exits or for, you know, to create their own wealth, when you ask them what they're going to do after they hit it, typically the answer is quite similar. And the answer is, I'm going to make all this money, I'm going to be so successful so I could turn off. Right? And it doesn't cost anything to turn off. And you don't need $50 million to turn off. And so as we recommend and we try to share our knowledge about how to make money, I also want us to be conscious that money is not the objective and that you can be happy and live the lifestyle that you want today with the means that you have. And wealth is actually an equation of, you know, living below your means every day gives you freedom, right? And so as much as we want to have means, as much as we all want that, we want prosperity, we want success, we want comfort for our families, our loved ones, and the generations that come after us. My conclusion in life is, and after that conversation, more and more I'm realizing that all the things that we actually want don't cost a thing. And so we give advice, we debate each other, we discuss, we disagree, we'll all be wealthy, but we also have to be conscious that we already are. Right? And so I think that's the message. And maybe in a year's time, we'll have another debate about money and we'll see how we feel about that. Hopefully we're still all wealthy and healthy.
I don't know how to follow that. How do we?
Yeah.
All right.
I wanted to
Universal truth.
All right. So that's it. That's the podcast.
Beautiful.
That's
Now
a great
the
ending.
QR code can start bouncing around.
So get steak.
Thank you all for participating. Thanks, Mark. Thanks, Manar. Thanks, Grammy. And thanks, Huddleback.